Are you a stock market investor or considering becoming one? Then pay close attention because today I'm going to talk about the 5 huge and very serious problems and drawbacks and that unfortunately are unavoidable when investing in a stock market the traditional way. And more importantly, I'm going to reveal how you can overcome all those problems and drawbacks so that you can easily and confidently build, grow and protect wealth by investing in a stock market in the best and most effective way. Because these problems and drawbacks that I'm going to mention in a moment and that come with investing in a stock market the traditional way affect all stock market investors, whether they're aware about it or not. These problems and drawbacks hold all stock market investors back, drag them down, and ultimately prevent them from making serious money and from achieving the outcome they were hoping for when investing. So I strongly recommend you watch this video until the very end because if you are currently investing in the stock market or would like to at some point, in the next few minutes you are going to discover something pretty revealing and frankly eye-opening. Okay, so what are these big and serious issues that come when you invest in the stock market in the traditional way and that prevent you from achieving the desired outcome, i.e. that prevent you from making as much money as possible with as little risk as possible? I'm going to list all these problems quickly right now and then I will come back to them one by one, explain and expand a bit more and then give you the best cure, so to speak, to avoid all these problems. Problem number 1, volatility. Okay, so first of all, and problem number 1, there's a market volatility. We know that the stock market can be volatile and prices can fluctuate rapidly, which can, and often do, result in significant losses. Problem number 2, lack of control. Investors have little control over the companies in which they invest in. Even if they do their due diligence and invest in well-managed companies, unexpected events such as scandals, changing in regulations, or shifts in the industry can significantly impact stock prices. Problem number 3, unpredictable and overall poor returns. It is difficult and in fact it's impossible to predict how a particular stock will perform in the short term or even in the long term for that matter. Even stocks that appear to be sound investments can underperform or lose value, resulting in losses for investors. And even if you invest more passively in the broader stock market, for example by ETFs or mutual funds, still the returns achievable, if positive at all, are very erratic and are strongly affected by market conditions, by how the economy is doing, by any geopolitical situations, by investor sentiment, and by many other factors. This means that, all in all, the overall broad stock market return one gets is actually pretty poor and quite disappointing, averaging historically a mere 7% a year, if that, and if you've been lucky. Which is hardly exciting and definitely not a return that will get you to build and grow wealth in any meaningful way within a reasonable time frame. On the top of that, investors can expect to actually achieve returns even lower than that for a variety of reasons that I will explore later in the video. Problem number 4, high risk. Investing in the stock market carries a high degree of risk. Investors can potentially lose all or a significant portion of their investment if the market experiences a drawdown or the companies in which they invest in perform poorly. Problem number 5, emotional investing. Many investors let their emotions guide their investment decisions, which often leads to poor choices and ultimately losses. Fear, greed, and panic can all influence investment decisions, and it can be difficult to maintain a disciplined long-term investment strategy. Now, some investors are under the illusion that some of the problems that I've just mentioned can be solved by diversification. For example, by investing in broader stock market indices via mutual funds or ETFs, which are supposedly diversified, or by relying on analysts or so-called experts to pick stocks, or even by believing that they can time the market themselves. The thing is, all these are just pure illusions. First of all, most broad stock market indices, ETFs or mutual funds are actually not truly diversified, in virtue of the fact that because of the way these ETFs or mutual funds are structured and how capital is allocated, the vast majority of the assets in those ETFs and in those mutual funds end up being invested proportionally to the market cap of those companies. So in reality, those indices, those ETFs, and those mutual funds are much more concentrated than investors are led to believe. So the advice that investors receive by financial advisors to invest in broad stock market indices via ETFs or mutual funds, which return, by the way, is also substantially reduced by costs and fees, is often just bad advice. because the investors that are advised that way end up getting a return which is even lower than the return delivered by the stock market, which on its own is already depressing if your aim is to build and grow wealth within a reasonable time frame. Look, the return that you can achieve by investing in broad stock market indices, ETFs, is poor, and by definition, at most, in line with the market return, which, as I've just said, is overall hardly exciting. Not to mention the disappointment experienced by those investors who try to outperform the market by investing in mutual funds, which are supposed to deliver better returns than the market, but which we know that after fees and costs, in reality, in general, end up delivering lower returns than you would get by investing more passively via ETFs. The issue is also aggravated by the fact that the reality is that the vast majority of mutual funds, which again are supposed to perform better than the underlying market, in reality end up underperforming the market, despite those funds being managed by professionals who should know how to outperform the market. But the truth is, data that spans over many decades show that they actually don't. And in most cases, you're better off investing in ETFs instead of investing in mutual funds. Because even though mutual funds are supposed to do better than ETFs in general, and in most cases, again, they simply don't. In any case, look, the thing is, no matter whether you manage to achieve on average the stock market return or slightly below market return, or even slightly above market return, that return overall is going to be low, not exciting, and definitely is not going to get you to build and grow wealth in any meaningful way within a reasonable amount of time. This means that no matter whether you invest in the stock market in the traditional way via ETFs or mutual funds, well, that approach unfortunately does not give you a true opportunity to build and grow any meaningful wealth, unless you're prepared to wait many decades. But who wants to be wealthy on their deathbed, right? So what do some stock market investors who realize this try to do? Well, rather than investing in the stock market via ETFs or mutual funds, they often resort to try to boost the return they can achieve on their investment by trying to pick stocks themselves, with the hope to capture the next Tesla, the next Amazon, the next Facebook, the next Google, or the next Netflix. They do that with the hope that should one or more of the stocks they pick end up blowing up, their gains could move the needle, so to speak, on their financial situation, which is great in theory. But the problem is that although picking stocks that are going to deliver stellar returns seems easy to do, that is so only with the benefit of hindsight. So the harsh reality is that capturing those home runs is incredibly difficult. Most investors won't be able to pick and invest in those stocks, and they won't be able to capture the very best opportunities that the stock market makes available, and surely not consistently. And in fact, the vast majority of investors who try to pick stocks themselves end up with achieving overall very poor returns, even below market returns. And sometimes, in the attempt to try to make more money, they actually end up even losing money altogether. Sometimes a lot of it. Hence, those investors end up being even worse off than they would have been had they invested passively via mutual funds or ETFs, which, by the way, again, as I said before, is bad enough and hardly exciting. So look, investors who invest by trying to pick stocks themselves end up with very poor returns, if they're lucky, and even losing money overall, which is an incredibly poor outcome considering the risk taken when investing in single stocks. A low or even negative return achieved by taking big risks constitutes a very poor investment, and surely that's the opposite of what investors should be doing in order to build and grow wealth. And finally, when it comes to the crazy and unrealistic beliefs that most stock market investors have to consistently be able to time the market, so to be able to sell their stock market investments and be out just before a crash or bear market and get back in at the bottom in order to minimize losses during bad periods and make lots of money during good periods, well, that is the mother of all stock market investors' illusions. No one is able to do so, not consistently at least. Not even the professionals, and those who call themselves expert can do so. So summarizing, look, it's true, the stock market can deliver relatively attractive returns compared to other asset classes, or so most investors are led to believe. and I'll come back to that in a moment. But in reality, those returns that investors actually achieve are not that attractive after all, no matter whether they invest in the stock market passively via ETFs or mutual funds, or more actively by trying to pick stocks themselves, not to mention by trying to time the market themselves. And in any case, let's face it, the price to pay for those returns is the very high volatility and the great risk that comes with investing in the stock market in the traditional way. Because look, we all know that the stock market can be extremely volatile, unpredictable, and prices can fluctuate rapidly, which can result in significant losses. Not only that, but the stock market volatility often manifests itself in full-on bear markets, sometimes brutal, persistent, and often emotionally draining for investors. In addition, dramatic stock market crashes are not infrequent at all, and most investors tend to have a short memory and underestimate how often those events actually occur. Just look at history. So no matter whether that's because of a crisis of some sort, because of a bear market, a recession, or because of a market crash, it's extremely common for stock market investors to experience very large drawdowns on their invested capital and be down on their stock market investments by 30%, 50%, 70%, or even more. That is a very challenging situation to be in, extremely painful and emotionally draining for investors. So much so that most investors end up engaging in counterproductive behaviors, such as selling during a bear market or selling after a market correction or crash, often missing out partially or completely on the recovery that comes next. That invariably affects the overall return on the investment that most stock market investors are able to achieve, which again end up being pretty poor and disappointing, completely failing to meet the initial expectations that those investors had when investing. And in any case, even if investors don't sell when they shouldn't during those events, even if they hold on to their investments until the market storm is over, they often have no choice other than being forced to wait years just to recover their losses and see their investment be back to the pre-bear market or pre-crash levels. By the way, that recovery, for various reasons, sometimes does not even happen at all, and often investors end up losing part or even all their invested capital. In any case, these long periods when an investment is underwater or experiencing a drawdown with substantially negative returns are a true killer of the overall return that stock market investors achieve. So, long story short, the harsh truth is that the goals and dreams of building and growing wealth by investing in the stock market completely fade when facing the reality that comes from investing in the stock market in the traditional way. So what happens is that investors end up giving up on their hopes and dreams that they initially had and resign to mediocre expectations and ultimately to a mediocre life. Basically, they resign to the reality of being able to achieve returns that, in the best case scenario, average only about 7% a year, while also knowing that they will surely experience at some point, and in fact many times over a lifetime, the dreadful and scary situation of being down 30%, 50%, 70% or more. Well, making at best a 7% a year average return with a prospect of being down multiple times 30%, 50%, 70% or more is pretty far from being a great deal if you ask me, no matter what financial advisors say or recommend. That way of investing is not smart, is not wise, and certainly not life-changing. For every $10,000 invested, the prospect of making on average $700 a year while suffering up to $7,000 losses on the invested capital multiple times over the years is hardly attractive. It's clear that the return to risk profile when investing in the stock market the traditional way is very heavily skewed towards the risk side of the equation. A much more compelling proposition would be the opposite, right? So for example, taking our $10,000 investment, the possibility of making $7,000 in a year with a risk of being temporarily down at any point just $700 is certainly much more enticing. And ultimately, that's the type of return to risk profile that a smart and savvy investor should be looking for. Because as with any investment, you want the return to risk profile to be skewed to the return side, not to the risk side. In other words, you want to risk as little as possible to make as much as possible. Unfortunately, by investing in the stock market the traditional way, you take a very large risk, up to 70% or more, to achieve little return, which we know that at best can average a mere 7% a year. And believe it or not, this is exactly what the very vast majority of stock market investors are prepared and resigned to face and accept, which is pretty sad. So my question to you is, why accept that? Why resign to that if there is a better way? The thing is, most investors ignore the fact that there actually is a better way, a much better way in fact. So why don't investors know about this much better way to investing in a stock market? Well, very simply because it is in no one's interest for you to be able to make a lot of money and become wealthy by investing in the stock market. Why would it? Why would anyone care about you making a lot of money by investing in the stock market? Why would anyone tell you how to do that? The sad reality is that the interest of the current financial system, the way it is structured, is not to get you to make as much money as possible, but it is to take as much money from you as possible. And how does that happen? Well, the current financial system is designed to lead you to believe that you should invest in the stock market the traditional way, which is the way that forces you to pay all the costs and fees that come along with investing in such way, for example, by buying ETFs and mutual funds, all of which does nothing else other than enriching all the players in the space, but not you, while you get to keep only a very small portion of the pie. In other words, you're left with the crumbs of the pie, when you could have the pie itself, if only you knew how. And guess what? The pie itself is instead enjoyed by someone else, with thanks. Look, the secret that no one tells you, no bank, no financial advisor, no institution, no education provider, no one, is that you actually can do extremely well for yourself by investing in the stock market, if you only knew the way, that is. So do you want to stop believing the nonsense that you're being told and stop resigning to just getting the crumbs of the stock market investment pie? What about you get the pie itself instead? That's a much better proposition, right? So I have a question for you. Do you finally want to build, grow and protect true, sustainable, exponential, perpetual and bulletproof life-changing wealth by investing in the stock market? Well, let me reveal to you that is possible. Do you want to know how to achieve stock market type of gains but on steroids without any of the stock market risk? Well, again, that is possible, and I'm about to reveal to you how to do just that. So keep watching. So what's the solution then? What's the much better way of investing in a stock market that allows you to build and grow true wealth in a reasonable time frame, while at the same time protecting it by dramatically reducing the risk you're exposed to at any point in time? Well, without further ado, let me finally reveal to you the way. So what you need to do is to first find a very effective and robust method to remove or dramatically reduce your investment drawdowns, so that you never find yourself in a situation of being down 30%, 50%, 70% or more on your invested capital. Because, as I said before, that is truly a killer. That is devastating from both an investment return point of view and also from an emotional point of view. Not to mention from the point of view of being able to build and grow true wealth consistently. Second, what you need to do is remove the dependence of your investment returns from the performance of the broader stock market itself, from how the economy is doing, or from any other external factors. And indeed, if your preference is to invest more actively in single stocks rather than more passively via ETFs or mutual funds, you also must remove the dependence of your investment returns by your ability or lack to be able to pick the best stocks yourself, or of course the ability or lack of anybody else whom recommendation you might be following or consider following when it comes to picking stocks. And finally, given that, as I explained before, the return you get from investing in the stock market in the traditional way is not that great and surely not attractive, especially if you want to build and grow wealth as fast as possible, what you must do is increase dramatically the return on your investment that you can achieve. And how do you do that? You do that by being able to consistently, and consistently is key here, pick the best stocks, those with the highest potential, i.e., those stocks that have the highest chances to go up in value the most in the shortest time possible. And then you also need to be able to ruthlessly and consistently, and again, consistently is key, sell any stocks that you bought at the right time, before their performance deteriorates, so that you can actually secure the profits that you've worked so smart and so hard to get. And what do you do with those profits once you take them? Well, very simply, you reinvest them again into what are the new best stocks, those with the highest potential at that point, i.e., those stocks that have the highest chances to go up in value the most in the shortest time possible. Only by following this process and by doing so consistently can you actually build, grow, and protect sustainable, exponential, perpetual, and bulletproof life-changing wealth by investing in the stock market. But that is still not enough, because, as I said before, you need to be able to remove or dramatically reduce your investment drawdowns, so that you never find yourself in a situation of being down 30%, 50%, 70% or more on your invested capital. Because the first rule of successful investing is never lose money. And how do you do that? Well, you need to know very precisely and objectively, thanks to a proven and robust system that you need to follow, whether at any point in time you should be in the market as the market conditions are favorable, or you better stay out of the market as market conditions are not favorable. When you're in the market, your focus should be in making as much money as possible, and you do that by investing in the best stocks, those with the highest potential, i.e., in those stocks that again have the highest chances to go up in value the most in the shortest time possible, so that you can maximize your return on your investment while market conditions are favorable. But when you are out of the market, you are protecting your portfolio and your wealth. Hence, avoid losses during those unfavorable market conditions so that you can resume aggressively accumulating wealth again from a much higher capital base as soon as good market conditions return. Pretty smart, right? Look, I'm telling you this because I myself have worked in the investment management and hedge fund industries for over 2 decades, professionally managing portfolios worth up to billions of dollars. And let me tell you, during my career, I have developed and successfully applied powerful and effective systems that allowed me to make huge amounts of money for clients and investors. And you'll be very pleased to hear that among those methods and systems that I've developed, the one that I'm alluding to here is the most powerful and the most effective system that I've developed and refined over my 20+ years of professional career. And let me reveal to you that this stock market investing system is actually extremely easy to follow, and it works really well, because it is going to help you achieve extremely high returns, but does not require you to take any of the risks that would come by investing in the stock market in any other way. And the great thing is, this system requires also very little time commitment on your part, because that allows you to achieve extraordinary results and returns with a time commitment of just up to 1 hour a month, if that. So I'm sure you're now asking yourself, how do I practically follow this method? What are the details? How do I apply this system in real life? What do I actually need to do to get started using this system and make this work for me? Well, I completely understand why you're probably so intrigued and so interested by this game-changing approach to investing in the stock market. I would myself be dying and wanting to know more if I didn't already know this. Look, I always get the same reaction from people when I share this stuff. And given the amount of people who keep asking me for more information and for more details, and also given the fact that going deeper and explaining all the details right now would require more time than the time allowed by a short YouTube video, what I recently decided to do is to put together a 100% free masterclass where I reveal and explain everything you need to know in depth and give you all the details so that you can go ahead and apply this stock market investing approach straight away. You'll be very pleased to hear that during the session I unpack and break everything down so that once you attend it, you'll be able to confidently apply this extremely effective system to your own stock market investments. That one will solve all the issues and problems that I mentioned earlier when it comes to investing in the stock market, and two will completely transform the results you are going to get going forward starting immediately. Plus, during the masterclass, should you wish to, I'm also going to give you the chance to access our powerful software that will do all the work for you so you won't have to. Again, this masterclass is completely free for you to register for and attend, so you literally have nothing to lose to sign up. Just lots to learn and loads to gain. Just click on the link below to save your seat and you will be taken to the webinar registration page where you'll be able to choose among the next available sessions the one that works best for you. So look, if you want to be able to consistently capture the very best opportunities that the stock market makes and will make available at any given time, and yes, including getting in early in the next Tesla, the next Apple, the next Microsoft, or the next Google, if you want to make way more money that you would be able to by investing in the stock market via mutual funds, ETFs, or by picking stocks yourself, while at the same time avoiding the risk of being exposed to market crashes or bear markets, if you want the peace of mind that comes from knowing that you won't have to make any decisions yourself, with the risk of emotions messing everything up, then this masterclass is specifically for you. And by the way, this applies irrespective of whether you have very little, some, or a lot of money to start with. It doesn't really matter. Look, the reality is that if you don't take action right now and don't register for this masterclass, you will just keep getting the results you've always got. And you will remain an average stock market investor, with average, hence disappointing, and surely not life-changing and not true wealth-building type of returns. But if you decide to get off the fence and take this small but likely life-changing decision to register to the webinar, well, you will join pretty much immediately the 0.01% of stock market investors who are able to achieve incredible and consistently superior returns that will finally allow you to build, grow, and protect true, sustainable, exponential, perpetual, and bulletproof life-changing wealth, pretty much on autopilot by dedicating to this just up to 1 hour a month, if that. Okay, so I truly hope you decide to join me on this free masterclass because again, you truly have nothing to lose to attend and a lot to gain. All you have to do is invest just a couple of hours or so of your time so that you can learn this simple yet incredibly powerful and effective method that will change once and for all the way you approach stock market investing and indeed, most importantly, the returns that you're going to achieve. Because what you're going to learn not only will it help you to avoid all the big problems and drawbacks that come with investing in the stock market the traditional way, but it will also help you achieve previously unthinkable results. So again, highly recommended. Right, all that being said, if you're finding this video interesting, valuable, or inspirational, please don't forget to click the like button. Also, if you would like to remain up to date with what we do and with how we can help you achieve your financial freedom goals here at the Financial Freedom Hub, or if you simply found this video valuable, in that case, if you haven't already, a subscribe would mean a lot to us, because it supports the channel, and what that also does, it gives us an indication that we're building an audience and that we're creating helpful content for people. And when you do subscribe, remember to click the notification bell so that you can get notified as soon as we release a new video. Also, please leave a comment down below and let us know how your experience has been so far when it comes to investing in the stock market. Did you manage to make some money and achieve the same returns as the market, or higher than the market? If so, how much higher and for how long? Or did you end up losing money and being disappointed? And what approach did you apply when investing? Did you go the passive route and bought mutual funds or ETFs? Or did you decide to take a more active approach and pick stocks yourself? And if the latter, what kind of outcomes did you manage to achieve? And if overall you managed to make some money, has that been life-changing? or not really? Share all that with us and with the other financial freedom hubbers in the comments below, and let's get the conversation going. Also, let me know in the comments below what you would like our next video to be about. And if you haven't been satisfied with your stock market portfolio performance, well, now you know what you need to do in order to change that, right? Link in the description. And finally, please share this video with family, friends, or with anyone you think could find this video or our channel interesting, valuable, educational, or inspirational. Right, that's it for now. Time for you to make a decision, I guess. Do you want to keep being an average stock market investor, hence achieve average and not life-changing at all returns? Or do you want to approach investing in the stock market in the way that elite investors approach it, and in a way that can change your financial situation and your life for good? And remember, action taking is a trait that characterizes all successful people and all successful stock market investors. You can become one of them starting today by grabbing this incredible opportunity and signing up to my free masterclass. So I'm looking forward to seeing you there. And of course, I'll see you also on the next video. Until then, take action, ride opportunities, always seek true freedom, be resilient, be consistent, carry on persistent, stay relentless, and most of all, remain unstoppable. Oh, by the way, if you liked this video, I'm sure you're going to absolutely love the one or the ones appearing now on the screen. So I strongly recommend you go watch them right now. I'll see you there.